Hello everyone, welcome back. First, let's look at Monday's closing picture. On July 27th, Apple rose 1.17%. With a market capitalization of $4.93 trillion, it overtook Nvidia and reclaimed the title of the world's most valuable company.
At the same time, Nvidia fell nearly 5%, closed below $200, and saw roughly $250 billion in market value erased in a single day. The Philadelphia Semiconductor Index fell nearly 5% at one point. Money is rotating out of AI chip stocks and into mega-cap tech and software names. Meanwhile, Bank of America closed at $62, continuing to hold around the strong $62 area. Chubb closed at $356, still leaving room before its 52-week high of $365.29. This is the real state of the current market. AI chip stocks are under pressure, while financials, insurance, and selected tech giants are absorbing the money flow. A massive investment plan was reported. So why did Nvidia sell off immediately? What triggered Nvidia's decline on July 27th was a financing report. Nvidia is in talks to provide OpenAI with approximately $250 billion in financing guarantees to help it lease data centers, while also discussing another $350 billion in chip purchase financing. The market is beginning to worry that Nvidia is playing three roles at once: supplier, investor, and financing guarantor. Nvidia helps customers secure financing. Customers use the funds they raise to buy Nvidia chips, and Nvidia then recognizes the order revenue. Critics point out that capital is increasingly being used to fund future AI customers and infrastructure deployment. Nvidia's 5-year credit default swap, CDS, spread widened by 14 basis points in a single day to 82 basis points, the largest single-day increase on record. The credit market has begun to price Nvidia's financial risk, but Nvidia's fundamentals have not collapsed. Its products remain in short supply, and its next-generation Rubin platform has already begun to be adopted by large-scale projects. What has really changed is the price the market is willing to pay for these commitments. By contrast, the defensive framework and resilient stocks we have long emphasized on this channel have continued to rise recently. Microsoft, Bank of America, and Chubb. 1. Microsoft closed at $389 on Monday, up 1.94%. Our previous view was that $390 to $394 was the primary accumulation zone, while $377 to $382 was the short-term observation zone. On July 27th, Microsoft traded as low as $388 intraday and closed at $389, placing the price right near the lower edge of the $390 to $394 zone. From a technical structure perspective, its 52-week range is $349 to $556, and the current $389 level still sits in the lower middle part of that range. Key levels to watch. Microsoft is scheduled to report earnings on July 29th. Azure growth, AI capital expenditure, and free cash flow are the three core watch points. Before earnings, the $387 to $390 zone is current support. If it breaks, watch the $377 to $382 area. On the upside, the stock needs to reclaim $395 to confirm that the short-term rebound is continuing. 2. Bank of America. Bank of America, strong continuation after the dividend increase. Bank of America closed at $62 on Monday. Our previous view was that BAC would look for buyers around $60, while a close above 62.10 to 62.30 would confirm a new uptrend. On July 27th, BAC traded as high as $63 intraday and closed around $62, keeping it close to the confirmation zone. A sustained close above 62.10 to $62.30 would provide stronger confirmation of the new uptrend. Key levels to watch. The $62 area is becoming the new support. If the stock can hold above $62, the next target is $64 to $65.50. If it falls below $61.50, the validity of the breakout needs to be reassessed. 3. Chubb, steady advance after earnings validation. Chubb closed near $356 on Monday after trading as high as $362. Based on the current setup, the stock remains close to its 52-week high. Its current PE ratio is 12.73 times, and its 52-week range is $264 to $365. Key levels to watch. The $358 to $362 range is the current primary trading band. If the stock breaks above $362, the next target is the previous high near $365. If it pulls back to $353 to $355 without any deterioration in fundamentals, that could be viewed as a secondary opportunity. A stop loss can be placed below $350.
4. Conclusion. Market rotation is accelerating. Retail investors should prioritize defense. The core feature of the current market is that money is rotating out of AI chip stocks on a large scale, but it is not leaving the equity market. It is moving into financials, insurance, and selected tech giants. The previous trading watch points for Microsoft, Bank of America, and Chubb have all been validated by the market. Microsoft found buying interest near the $390 to $394 zone. BAC held around the $62 confirmation area, and CB steadily climbed toward the $359 area after earnings. This week, Microsoft on July 29th, followed by Meta and Amazon, will report earnings one after another. These reports will test whether AI spending can translate into actual revenue and profits. If customers can prove that AI is generating commercial returns, concerns around Nvidia may ease temporarily. If customers continue to raise capital expenditures while free cash flow declines, the entire tech sector could face a second round of valuation adjustments. For retail investors, the current environment is better suited to defense than chasing highs. The key levels for the three defensive stocks remain clear. Watch Microsoft's direction after earnings, whether BAC can hold $62, and whether CB can break above $362. Until the financing concerns in the AI chip sector are clarified, making fewer directional bets and waiting for confirmation matters more than trying to front-run the market. The above content is for market information organization only and does not constitute investment advice. Please make independent judgments based on your own investment horizon and risk tolerance.